Inflation is rising, economic growth is slowing, and unemployment isn't looking any better. If you think this sounds like a perfect storm, you're right. Economists call this stagflation, and it's one of the most difficult challenges any economy can face. Stagflation is what happens when you get the worst of both worlds: high inflation and high unemployment at the same time. It goes against what many economists used to believe, because according to older models, inflation and unemployment were supposed to move in opposite directions. For a long time, the Phillips Curve was the gold standard. It suggested a simple trade-off. If you want to reduce unemployment, you might have to accept a bit more inflation, and vice versa. But stagflation turns that idea on its head. The most infamous case of stagflation happened in the 1970s. It all started when oil prices suddenly skyrocketed after OPEC cut back production. The price of oil quadrupled. And since oil fuels everything from transportation to manufacturing, the entire global economy took a hit. Prices surged. People lost jobs. Growth slowed down. Governments responded by trying to stimulate demand, spending more, printing more money, but instead of fixing the problem, they just made inflation worse. That was when economists like Milton Friedman and Edmund Phelps came in with a new idea. It's not just about how much money is in the economy, it's about what people expect to happen. If people believe prices will keep rising, they'll act like it, asking for higher wages, raising prices, and reinforcing inflation. Once inflation expectations get out of control, it becomes very hard to stop the cycle. Fast forward to today. We're not in the 1970s, but there are some eerie similarities. After the COVID-19 pandemic, global supply chains were in chaos. At the same time, governments around the world were pouring money into their economies to keep people and businesses afloat. That combination, restricted supply and strong demand, pushed prices up. And then came the war in Ukraine, which drove up food and energy prices even more. So here we are again. Inflation is up, economic growth is uncertain, and central banks are stuck between a rock and a hard place. If they raise interest rates to control inflation, they risk slowing the economy and increasing unemployment. But if they don't act, inflation could spiral even further. So what can governments do? Unfortunately, there's no easy fix for stagflation. Traditional tools like cutting interest rates or increasing government spending won't work when inflation is already high. Instead, the answer lies in long-term solutions. That means improving productivity, reforming labor markets, investing in energy independence, and making supply chains more resilient. These are structural changes, not quick fixes, but they're the only real path forward. Looking back, the lesson from the 1970s is clear. Don't ignore inflation, and don't try to stimulate demand during a supply-side crisis. The real danger isn't just high prices, it's losing control of expectations. Stagflation may not be fully here yet, but the warning signs are hard to ignore. With climate shocks, geopolitical tensions, and fragile global systems, we need to prepare for more than just inflation or recession. We need to be ready for both at once. So the next time you see prices rising and job growth stalling, you'll know it's not just bad luck. It might be stagflation knocking on the door. Until next time, stay informed, stay curious, and keep thinking critically about the forces shaping our world.